All right, quick video on how the bank calculates debt to income ratio when you're going for a mortgage. So, for example, let's say you make $10,000 a month gross. That's your income. Let's say your new mortgage payment with principal, interest, taxes, and insurance is $3,300. If there's an HOA, they're going to add that, but let's just use $3,300 for this example. Let's say on your credit report you have some credit card minimums, some student loans, and a car payment that add up to $1,200 a month. That's what they're going to use. They're going to use what's on the credit report. They're not going to look at your electricity or car insurance or anything like that. It's going to be what's on your credit report. Plus, if you're paying alimony or child support, they'll include that in that number too. So you make $10,000 a month. Your mortgage payment is $3,300. You have $1,200 in other expenses. Your total debt to income ratio is going to be 45% because you're going to add your mortgage payment $3,300 plus $1,200. That's $4,500. Out of 10,000, that's 45%. So that's what the bank's going to say that your debt to income ratio is. And usually, if you're 45% or below, that's going to be within guidelines for conventional and FHA. In some cases, you can go 50%, and on FHA, some cases you can go over 50% and VA. On the back end, that's your housing and your debt. Your housing expense debt to income ratio will be 33%, 3,300 and 10,000. So that's your housing debt to income ratio is your front end debt to income ratio, and then your housing plus all your other debts is your back end. So they're going to go by the back end, and that's how the bank's going to calculate your debt to income ratio. And depending on the program, that's where you're going to want to be between 45 and maybe 55, depending on the program. So if you have any questions on this, please let me know, and have a great day.